Okay, let's jump right in. Welcome to The Explainer. I'm stepping into the role of your lead equity analyst today, and we're going to put MaxLinear stock through a seriously rigorous financial autopsy to uncover its true intrinsic value. We're going to look right past the hype, cut through all that market noise, and rely purely on the fundamental data pulled straight from the company's latest filings. Our ultimate goal? To see if the hard numbers actually support the stock's current trajectory. Now, the staggering starting number we've got to address right out of the gate is MaxLinear's current market price, $78.12 per share. If you've been following the momentum on this one, you already know that's up a massive 348% year to date. And honestly, looking at the latest filings, the trailing 12-month total return is over 600%. That kind of wild price action automatically begs a huge question. Is this explosive growth driven by actual underlying cash flow, or is it just pure speculative momentum? Well, here is the massive expectation versus reality gap we're going to explore today. Based on the fundamental data, we've calculated a fair value of just $8.48 per share. When you put that fundamental value up against the $78 trading price, you get a shocking negative 821% margin of safety. I mean, that is an absolute chasm between what the market is currently paying and what the baseline financials say this business is actually worth.
To solve this valuation mystery, we're going to run MaxLinear through our valuation gauntlet. We'll start with the mystery itself, move into absolute valuation models, check out relative valuation in peers, dive into an asset-based valuation, and finally, bring it all together for our verdict.
Starting with Part 1, Absolute Valuation Models, where we go searching for the actual cash flow. As professional equity analysts, we almost always start with the dividend discount model, or DDM. It calculates the present value of all expected future dividend payments, giving us the most direct, straightforward measure of cash returning right to your pocket as an investor.
However, valuing MaxLinear with the dividend model is, well, it's literally like valuing a dry well. The quarterly filings are super clear here. They have a 0% dividend compound annual growth rate. Because they pay absolutely zero dividends to shareholders right now, this particular model values the stock at exactly $0. Obviously, for a growth-oriented tech company, we're going to need a completely different tool.
So, we have to shift gears to a discounted cash flow, or DCF, and a residual income approach. DCF projects the future free cash flows and discounts them back to today using the company's cost of capital. The residual income model does something kind of similar, but it takes current book value and adds future net income minus an equity charge. Let's break down the step-by-step math on this. The filings show a really tiny $2.1 million in trailing free cash flow paired with a deeply negative net income, minus $132.1 million to be exact. When you plug that meager cash generation into the formula, assuming a pretty standard 2.5% terminal growth rate and discounting it by a 5.5% market risk premium, it spits out that exact $8.48 fair value. And honestly, because net income is so far in the red, the residual income model points to a similarly bleak valuation. The absolute cash generation simply does not support a multi-billion-dollar market cap right now.
Let's move on to Part 2, Relative Valuation and Peers, to get some much-needed market context.
Since we're lacking specific direct peer comparisons in the primary filings, we're making the sensible analytical assumption here to benchmark MaxLinear against standard, profitable mid-cap semiconductor and networking companies.
The current disconnect in pricing is pretty wild. On one hand, MaxLinear has a deeply negative trailing price-to-earnings ratio of negative 51.39, which is driven entirely by those heavy recent net losses. But then, on the flip side, they've got a forward PE of 25.25. This tells us the market is basically ignoring the current financial reality and pricing in a massive, highly profitable future turnaround.
When we pull up the standard relative multiples, the picture gets even more strained. Actually, scratch that. It completely breaks standard comparative models. We see an enterprise value to EBITDA ratio of negative 190. And get this, a staggering price-to-free cash flow ratio of over 3,255. You're paying an incredible sky-high premium for every single dollar of sales or free cash flow compared to any normal profitable peer in the space. All right, Part 3, Asset-Based Valuation. Let's see what's actually under the hood. Net asset value is a great tool because it allows us to strip away all those optimistic future growth assumptions and just look at the raw equity value of the company today. Put simply, what is the actual book value if we just subtract the liabilities from the assets? Using the provided metrics, we can easily back into the company's book value per share. The process is super straightforward. We take the current market stock price of $78.12 and we divide it by their price-to-book ratio, which the data lists at a heavily elevated 15.4. That simple math reveals an estimated net asset value of roughly $5.07 per share. Think about what that actually means in the real world. Investors buying in at $78 are paying an enormous premium. We're talking over 15 times above the actual, tangible asset value of the business.
Which brings us to part 4, our final synthesis and verdict. Let's talk about the reality gap. When we pull all this together, the reality gap is honestly impossible to ignore. The current market price sits at $78.12, but every single rigorous financial model we ran points to an intrinsic value that is entirely disconnected from that price. You've got $0 from dividends, $5.07 from hard assets, and $8.48 from discounted future cash flows. The fundamentals are just sitting in stark, undeniable contrast to the trading price.
Now, as objective analysts, we've got to acknowledge the context here, right? Each model definitely has weaknesses given the company's current unprofitable stage. For instance, DDM is pretty useless for non-dividend payers, and relative multiples are highly distorted right now by their negative 42% net profit margins. But the DCF anchors us to actual measurable cash flow, and the asset-based model gives us a really solid mathematical floor. The sheer wide discrepancy between these fundamental anchors and the market price indicates severe overvaluation based on their current fundamentals.
So, I want to leave you with this final thought to chew on. With a 348% year-to-date return that completely defies all intrinsic valuation models, you really have to ask yourself, are investors seeing a future operational turnaround that the current math simply can't capture yet? Or is a massive, gravity-driven correction completely inevitable? The data gives us the fundamental floor. How you trade the momentum is ultimately up to you. Thanks so much for joining me on this explainer, and remember, always keep questioning the numbers.